Good morning, everybody. It's just on 10:30. We will be just waiting a second for people to come in onto the webinar. We've got Brett Kelly, as you'll see on your screen, ready to start, but we'll just wait 1 minute as we allow some more people, some more participants to come in. They're all flooding in at the moment now. So just bear with us 1 minute. Thank you. So it's just after 10:30, and I'd just like to welcome you all to Market Eye's third instalment of our virtual investment conference series. We've got more people coming in at the moment, but I thought I'd just start with a brief intro before I hand across to Brett Kelly, founder, chairman, and CEO of Kelly Partners. We are delighted to host a number of our clients to present to groups of institutional retail investors and family offices and broker networks. And we have on our last two sessions, Tech on the 20th of May and ESG on the 26th of May, had over 600 investors participate across those sessions. So we're delighted to welcome you on board today to hear from this morning from Brett Kelly, from Zach Hellman, and from Chris Massis, from Kelly Partners, Angel Seafood, and Advent Health. The sessions are structured in 20 minutes, short, sharp focus, 10 to 15 minutes presentation, followed by Q&A. If you would like to ask a question, you can either put it in the chat or alternatively email me direct, ron.bechler, B-E-C-H-L-E-R, R-O-N-N.B-E-C-H-L-E-R @marketeye.com.au, and we'll have plenty of time to allow you to ask some questions and have a bit of a discussion off the back of the presentations. Today's sessions themed businesses responding to changing consumer needs. And with that, perhaps if I can hand across to you, Brett, to kick us off with the first presentation about Kelly Partners. I'll just move you into the host so you can share your screen. So Brett, you should be able to share your screen. Thank you.
Great. Thanks, Ron, and thanks everybody who's joined in today. Just a quick 20-minute update for the people that we've met before, or for new people that want to know more about who we are and what we do. I'll just start with respect to COVID. We went to remote working arrangements from mid-March. We've got a great network that allows our people to work seamlessly from anywhere in the world. And so we haven't had any particular drama with doing that. And so it's really been business as usual. There has been some impact on clients. It's made us very busy helping them. And there's obviously a lot of government policy that's being driven through accountants. So that's helped. I guess in response to the question, businesses responding to changing consumer needs, which is the topic for today, we think everything old is new again. In our space, using great technology to give even more personal, more customized service energetically to our clients is really the business that we're in. And so that's what we continue to do and to try and do that at scale. For people that have seen our last few presentations, we've tried to give people a one-page summary of Kelly Partners Group in 10 seconds. And basically, that's the story of a business that's doing the traditional work of chartered accounting, focused on tax and accounting for purely private business owners across our network. We've continually grown revenue now for 14 years, doing that half organic and half via acquisition. We've got very strong EBITDA margins, underlying NPAT-A, continual growth over time. There's a strong return on equity and not much debt, and then very, very strong cash flows. This is a business that performs well in a boom and will typically perform well in all parts of the cycle. And we think that over this period of the COVID crisis, we expect to see that over the next couple of years through a more challenged economy than I guess we've been used to over the last decade. Importantly, the business was founded in 2006, and we've doubled that business 4 times in a row, on average every 3 years. We don't expect that to be much different going forward, although we do expect in the 12 months from here with the crisis for it to be slightly harder to do deals. We've got good support from our bank and plenty of capacity financially to do deals. But in terms of counterparties, it is proving that accountants are struggling to get organised to do a deal at the moment, even though we've got a number, as always, in the pipeline. It's just hard when people are dealing with a crisis to also sell their firm. But we don't see any particular impact on our 5-year growth plan. We do know that the next 12 months will be more challenging than in other times. But what we've done is just put this clear format together to show that we have an existing group, the ability to grow that organically, and then grow through network expansion through a tuck-in acquisition. That's where we buy a firm and put it into an existing site. A marquee acquisition, which is where we buy a new site that has more than 2 million in revenues, or a greenfield site where we typically put a talented person into an empty office front, if you like, and build that. We've also got our new services or complementary services in wealth, finance, corporate advisory, and our investment office that continue to grow. And our target is to significantly grow the business over 5 years, and we consider ourselves on track to do that with a long track record of doing that. I'll leave some of these slides, given the small amount of time we've got today, but essentially we want a challenge in the market. We believe this is a huge market where I did a new client prospect meeting at 7:30 this morning. Same old story, not proactive service, been with the accountant for 15 years, looking for an alternate offer. We're challenging in the market with this focus on private business owners, with a structure that makes our partners owners, genuine owners of the business. Very strong growth that is driven by our ability to put about 40% of the average weekly time that a partner spends in a normal firm working on internal matters. We put that 40% of time back to the partner to service their clients and look after their teams and grow their teams. And that's achieved by our centralized service offering, what we call our specialized accounting services group, which is an internal offer where we take the administration of the business and we do that all internally. And then from a performance point of view, if we continue to deliver strong value to our clients, people, communities, investors, we should do okay. This is the size of the opportunity. It's a $12.2 billion market. It's the same size as the insurance broker market. In the insurance broker market, you've got Steadfast, AUB, who've got a big chunk of that market. But in our market, there's no one who's aggregated any significant size. We are now the 24th largest firm in the industry, and we're just basically in Sydney, a small office in Melbourne that is now growing and growing strongly. We see continual opportunity in this space, particularly as the boomers look to retire. This, I think, is quite interesting. The big 4 accounting firms are 75% consulting services. They're not really accounting firms. So if you take them out, then number 5 is Findex, which is largely a financial planning group. So really starting at BDO, we're 24th in a list where I would take 5 or 6, 7 of those out. McGrath-Nicol number 16 is an insolvency group. We have got to good scale, which does make a difference, and we've done it in a unique way, which is focused on places that are outside the CBDs, typically where there's a lot less established players. So clear mission and values, clear focus on SMEs, owner-driven businesses. Our structure is very different in that we invented this partner-owner-driver model of a 51-49% ownership model with a 10-year agreement, centralized back office, a clear system for the clients and our people, a strong brand that's the same across every office. And as a result, we've got very much above trend growth, 34% CAGR over 14 years. So to execute this 5-year plan, improve our EBITDA margin, it's already 2 times the industry, lower our operating cost. Our central management services are now at the right level to do the size of the group, plus probably another 50%. We want to accelerate tuck-ins within our discipline and proven deal framework. We've done 23 transactions, 28 partner deals to date. So, that's been continual over time rather than a rush of those at any one time. And we want to continue to build out our complementary services, obviously in finance and wealth and investment office, there's opportunity, and then establish additional marquee sites as we've outlined. The investment case we see is pretty straightforward. It is a holding company. We want to build intrinsic per share value. We see that our particular circle of competence is running accounting firms. We regard accounting firms as private businesses. And so we own many of those now. And 5 of them would in and of themselves qualify as top 100 firms in the country, which is a third of the firms that we own. So in terms of what we're trying to do, we firstly want to improve the earning power of our businesses. We've moved the margin back up to 30%. We want to increase the earnings through tuck-in acquisitions. We're buying on private company multiples, and the deals are structured, I think, in an intelligent and proven way that very much reduces risk to our group and to the vendor. Number 3, we want to participate in the growth of these businesses. We own a 51% equity share, which is a good chunk of the business where we can add value and grow that business and participate in the growth of those businesses. Number 4, we want to continually repurchase KPG shares when they're available at a meaningful discount. We regard the share prices at a meaningful discount generally, and where capital allows, we'll certainly continue to buy shares back. We have an open opportunity to do that at the moment. And from time to time, we'll make an occasional large acquisition, but we're not looking to do what we often hear termed transformative acquisitions. We've noted that transformative acquisitions are often transformative, but in the wrong direction. The business model, I think you'll see we've been listed for 3 years in June. And our plan always was to get listed and prove the model in the public markets. And we thought that was a 3 to 5 year exercise. So this is what we've always said about our business, that number 1, we've got recurring, defensive and highly diversified revenue streams. Number 2, that we've got a proven partner owner driver model that we invented. It's an operating model that very much creates alignment of interest and drives much beyond industry performance. Number 3, we've got very long-standing client relationships across a very diverse SME-focused client base. Number 4, a single brand. It's very key to us that we believe that a brand can build value over time. And so we've got a long-term strategy to drive organic growth, and our organic growth rate in the last 6 months to 31 December was about 11.5%, which is about 3 times the industry. Number 5, experienced partner owner driver model in a highly fragmented market. Because we've been doing this for a long time now, we've got quite a refined model and quite good at what we're doing. Number 6, it's a high margin but capital light business model. And 7, and I think number 6 is worth keeping in mind. There's high EBITDA margins and growing EBITDA margins, and in particular, we don't see us as needing to raise capital. We could raise capital on market at some point if there was something interesting to do. But primarily, we're about driving very strong returns on the capital that we have. And 7, the business is now, is focused on what we regard as a very large and underserviced market segment, and very much has above trend growth. In the last 9 months, we've added the Melbourne business, which gives us a foothold in Melbourne and a new market to grow in that we're excited about. That business is doing well. We've also added Lower Blue Mountains in New South Wales, which is another good spot. Understanding our geographic model, I think, is really important, because I was asked earlier this morning what makes us different. And one of those things that makes us different is that we've got 230 plus people, but we're not a general army. We're basically a whole bunch of SAS outfits that are located in the fastest growing regions of Australia. These places outside Sydney are growing. Sydney, New South Wales, a very strong and deep economy. And we own the largest and and or oldest firms in many of the markets in which we're participating. So markets like Wollongong, Southwest Sydney, Penrith, North Sydney, Central Coast, we are large in those markets, and Southern Highlands, and the businesses have been there a long time. And so the businesses have very good prospects to continually grow without suffering from the thing that happens in professional services, where you have so many people in one location and so much size in one location that it seems that no matter what comes into the top of the business, nobody knows what's going to come out the bottom. So it's very demotivating. You tend to see quite low growth rates in those businesses as a result. We've still got some places that we're looking to grow in terms of marquee and tuck-in opportunities. I'll leave you guys to have a look at that. We've got a full service offer to this private business owner client. These clients keep their accountants for a long time. They're generators of new and extra wealth, and they need a lot of service and want a lot of services from their advisors. Importantly, when we buy a firm, we can, without raising prices, very strongly improve the profitability of those businesses. And we do that through centralization, taking costs out, and making the businesses much more focused as a result. And there's a couple of examples of that there. The complementary businesses are growing. They're tiny, very, very small, but there's very much an opportunity to grow them. In particular, in the wealth space, we're not looking to do a transformative acquisition because we are unsure what the model for wealth management is in even the short term. There's a lot of movement around legislation, a lot of movement. The big banks couldn't make money. The big investment banks couldn't make money. I've seen more value destroyed in that space than any other over the last 15 years. So we're not sure how you would create value through an acquisition. And so we're just growing that organically with the clients that we have. In terms of results, the results are strong and growing. Organic revenue was up 16.5% at December. We don't see any reason that we can't grow in this market. It will be a little harder. We'll have to work a little harder. We've always aimed to grow at 5% organic and 5% through acquisition, so 10% a year. The next 12 months will be a challenge, I think, across the economy generally, and we'll just see what we can do within that context. The earnings of the business are strong. We don't see any reason that we can't continue to grow them. I think it's worth understanding that the headco owns 51% of the businesses, so often the numbers look a little smaller than they are. If you look at the size of the group and the earnings of the group, there's 10 million EBITDA. You can see there FY19, 10.2. You will see that over time, we expect the business will strongly grow, and that it's already a good sized business that's used to making money. Importantly, there's not much debt in the business. The margins are 2x the industry. And I just draw your attention to 32 is very strong cash flow, 100% cash conversion. I'm conscious that's about 15 minutes, Ron. I can take some questions. I guess the last comment, we've got another dividend that we'll declare, I think, next week or the week after. We do pay quarterly dividends. We do that because it's a very light capital business, and we don't anticipate needing to raise capital to buy things. But we haven't in the last 14 years, so we probably won't need to anytime soon. And that's, I guess I could take some questions.
That'd be great. Thanks, Brett. And just to remind everybody, either email me direct, ron.becchler@marketeye.com.au, or alternatively, you can put something in the chat. There's a couple of questions that have come in. Maybe first of all, given you touched on some of the numbers, Brett, a question from one of the people on the webinar. FY19 revenue grew slightly from 39.5 to 39.9 million, about 1%. What was the reason for that low revenue growth, and what do you expect this financial year?
Yeah, it's a good question. So we expect that our revenue growth in June, and it's, I'm conscious of putting something out to the market, but we expect that our revenues will be in line with, I think Morgan's have a research report out that has us at about 46 million. And at this point, We don't see any reason why that won't be the case. It's about 15%. And we're certainly, as of May, we're on track to do that number.
On the buyback, you mentioned how you use it as an opportunity to buy back stock that you see as undervalued. What do you consider the intrinsic value of the stock is? That's another question that's just come in. That's from Dean Fergie.
So Dean, nice to hear you. I was listening to Howard Marks this morning. He regards risk-free rate as zero, given the US Treasury is probably 30 years probably at 1% or close to zero. When I do a two-stage dividend discount with a moderate sort of discount rate, I see this thing as worth well over $1.50. You'll note I've been buying, not selling. I don't think I've ever sold a share on market. And as soon as we reorganise the balance sheet of the headco, we're taking the properties that we bought outside the headco, and we should have significantly more capital in the business. And if we don't, if we see the share price continually trade at the levels that it has, then we'll be a net buyer as we have been today.
Maybe if I can throw a question in, Brett. Obviously, COVID's been front of mind for investors and businesses over the past few months. Historically, you've grown both organically and through acquisitions. How does COVID impact on your acquisition strategy? How has it, and does it make things better or worse going forward for you?
So, Ron, the good news is that the COVID situation has convinced a lot of the older practitioners in the industry that this can be quite a hard way to make a dollar when you're in your 60s and there's this much pressure coming from the client base towards their accountant to help them. And so we've got a huge amount of incoming over the last 12 weeks. We are working strongly through that pipeline and expect that we'll, like every other year that we've existed, do some deals this year. We're driving careful terms. We've got good support from our bank to finance them. They're keen and we're keen. So we don't perceive any particular problem in getting deals done. They'll take a little bit longer because it's hard for the accountants to stay organised at the moment and be organised. So a couple I'm working on at the moment, it's just taking them a bit of time to get the due diligence because they've got so much going on in the business. The flip side of that is that we've had huge activity from the clients, and so needing help and wanting advice. So we do see that while there will be some pressure over the next 12 months, we think that some growth in the next 12 months will be quite different to what a lot of businesses will see. We see the business as very, very defensive. We don't have any consulting revenue in the business of any magnitude.
A question from the floor. This one from Mike Byrne. Can you give a sense to the listeners about participants about the strength of your bench? The members of your management team and the bench strength that they represent. Yeah,
so it's a great question. So the COO of our business, Christian Haig, has come directly out of 6 years at eBay, where he was, a senior exec. He's completed his, they put him through his program at Harvard. He's got great experience and he's adding value. Justin and Ken. Justin is our CFO, has come from Westpac, where he was a banker to our group about 6 or 7 years ago and was in institutional banking. So he's added a really great ability to look forward in terms of our numbers and project the future and manage our cash flows. And Ken, who's been with me for over 5 years, is our finance manager, chartered accountant, background in the business. He's very, very well versed in the business. Our head of risk was my boss at Pricewaterhouse when I was 18. He spent 25 plus years there as an audit partner, 9 years as their CFO. He's been with me for 12 years. So we do have a small but very strong and experienced senior group of people in our senior exec team. And these businesses that we own now, they are run by their partners at a local level. 95% of the results, come from the efforts of those partners working within our system that we've designed, and has been, every acquisition's on the same type of agreement. Every partnership operates on the same partnership agreement. We're all on one IT network. We're all banked by one bank. All the accounting's done centrally. So this is a business that is very well systemized and is not particularly dependent on me. What I particularly do is find new opportunities and do have an ability, more than nearly 14 years now of speaking to people that own accounting firms. And so often the first call comes from me. There's one we're speaking to at the moment that I've been speaking to for 7 years. So there's an embedded pipeline of deals from long-standing conversations. People don't decide to sell their accounting firm to you, not a firm that you want to buy just on a moment's notice. It typically takes some time to build those relationships, but we've been at it a long time now. So look, I consider we've got a very, very strong team, and I've never felt better actually about the team that we've got in the business.
Maybe if I can ask one last question before we hand over to our next speaker. How do you see the accounting profession changing going forward, and what are you doing in terms of Kelly Partners to take advantage of the opportunities you're seeing?
It's a great question, Rob. So this COVID situation has allowed us to train on our digital tools all of our team in ways that we couldn't have forced in a typical business environment, which I consider to be an enormous blessing to the business. So that's the first thing. So we see digitization and the use of digital tools as the future. However, in our space where people and families own these private businesses, we know they value a relationship with our teams and with our group that extends beyond something that can be done simply by the exchange of an email. So often they're judgments about how do I work with my children, bring my children into the business, how do I do intergenerational transfer of businesses and wealth, and the complexities that go with the families that own businesses. So that slide that I shared earlier, everything old is new again, right? So much, I think, I was on a call the other day, a lot of people saying, don't you think COVID's like the biggest, baddest thing ever to happen? Well, I consider that change has always been occurring. I think it's a temptation of ours to believe that the change occurring to us today is somehow greater than it has been ever in human history. I just don't think that's true. I think the invention of the steam engine, I think the invention of the phone, obviously the invention of the internet, but change is a constant. But the willingness to configure your business around the needs of your client and focus on the client, that's a constant. So that's really what drives us.
Well, Brett, thank you very much for that. If anybody would like any follow-up questions with Brett or want to have any sort of a briefing from him, either please contact Brett direct or let us at Market Eye know, and we'd be only happy to facilitate. So thanks very much, Brett. And what I might do now, if you can just, I'll just take back the host, sorry, 1 second, is I might just hand across to Eric, who can just introduce our next speaker, Zach Hellman, the founder and CEO of Angel Seafoods. Thanks, Eric. And hello, Zach. Thanks, Brett. Thanks, Brett.
Yeah, so we've got Angel Seafood, ticker code AS1, presenting next. So Zach Hellman is the founder and CEO of Angel Seafood. So I'll hand over to Zach to introduce the story and take you through his presentation.
By the way, I've just allowed Simba to share his screen. So we'll just let the slide deck come up.
Great.
Yeah, g'day all. I'm Zach. I'll be sharing our story with you all today. Thank you very much for joining us. We are a very small company in its infancy with enormous opportunity ahead. And today I'll be giving you guys some insight into our business and looking forward to hearing any questions after. For your benefit, those who don't know much about the oyster farming, that we'll just play a short video for you to get some insight into our operations, and then we'll go through the slide deck afterwards. I'll put my phone on mute while the video plays.
The Eyre Peninsula, mainland Australia to the north, Antarctica to the south. Australia's seafood frontier, oyster heaven, and the home of Angel Seafood.
The Eyre Peninsula is very remote. It's a remote part of the world. It's very unique. It's got rugged coastlines, lovely sandy beaches. It's surrounded by marine parks, conservation areas. These are clean, crisp, beautiful waters that hold good algae, good nutrients for healthy oyster promotion and growth.
Angel Seafoods emerged from a traditional family-owned oyster-growing business. Today, the Angel team are a dedicated, innovative, organically certified premium producer of Coffin Bay oysters. Currently, the South Australian oyster business generates $50 to $55 million per year, less than 1% of the world's production. The low volume and pristine environment means Australian oysters enjoy a premium position. Angel Seafood has a simple goal: produce fresh, clean, consistently high-quality oysters without compromising the environment. With oyster leases in Cowal and Coffin Bay, Angel's multi-bay strategy allows the company to take advantage of the best attributes of each bay, optimising growth rates and maximising product quality. Young oysters are carefully raised in Cowal. The ecosystem here is particularly good for nurturing our juvenile stock.
So the Franklin Harbour has a unique ecosystem with great nutrient upwellings that come out of the Spencer Gulf and south of that from the Antarctic. This promotes great food for the oysters with healthy algae. It's also organic. All these attributes pertain to our spat production and our organic certification.
Angel's organic certification was a worldwide industry first and requires a full audit by the South Australian Shellfish Quality Assurance Program every year. Adjustable long-line systems increase the water flow throughout the oyster farms, allowing the seabed to remain virtually untouched.
So oysters come in from our local hatcheries, all situated around the Eyre Peninsula. We deploy them out into the water. The oysters go over a water grater, which is very gentle. We use salt water for that grading process, so they're always within their natural environment. Then as they mature, they go over what we call a shaker grater, which is a little bit more vigorous, but it's starting to help that process for the oysters to start hardening up their shell, gaining adductor muscle strength, ready for translocation down to Coffin Bay for finishing.
Angel Seafood's systemised farming approach is ideally positioned to increase production. New leases and oysters tailored to meet customer demands are just some of the exciting opportunities in development. The final production stage happens here in Coffin Bay.
So the leases are about 15 kilometres from Coffin Bay here itself. There's no built-up areas out there. Really good food coming in through the opening of the bay. It's a lot more oceanic, you could say. It's got a really good tidal flow out there, and that gets the meat quality and the shell hardness up, ready for harvest.
When fully matured, the oysters are harvested, graded and then pre-chilled, ensuring maximum quality and shelf life.
So you want a nice, hard, round, deep oyster with a nice, plump, creamy meat in there.
Each batch of oysters is tracked to its final destination, ensuring a consistent, attractive appearance and fresh, delicate flavour for each oyster.
So the investment that's been put into Angel Seafood thus far allows us to scale up our business at an ever-increasing rate. We built up our leases, we built up our investment in our infrastructure, our boats, our sheds, our tractors. It gives us that passion, that drive, you know. We've got that innovative sort of spirit. It's great to see a company pulling ahead of the rest and showing that true innovation, that true passion and love for the oysters.
The company is now Australia's largest producer of Pacific oysters. Whether in Australia or around the world, this is Angel Seafood. Please enjoy.
Yeah, thanks, guys. So most people know about oysters being an aphrodisiac. It's a little bit of a myth. There's actually more to oysters than people know. They are a significant superfood with massive health benefits, and much like salmon and avocado, other healthy foods are increasing popularity. And oysters are really packed with lots of vitamins and nutrients that are very good for your immunity and brain function and other key body functions as well. We'll get into the next slide 4. Angels are now the largest producers in Australia. Here, we were founded in 2010, and we've seen significant upside in consolidating farms to build more scale. So we've listed in the 18 to fund that kind of investment, and it's proven to work quite well for us today. Yeah, in the half yearly, 3.3 million oysters sold, and operating cash flow positive, which is a good result. We are organic and sustainable certified, meeting consumer preference for healthy food and care for environment. We built the business to a size where we can benefit from these economies to scale now. Early evidence shows our model consolidation and scale is very effective. Now holding 22 million graded oysters, capacity to finish 10 million oysters for each year, and growth opportunities further consolidation, vertical integration and branding are all on the horizon. Next slide. This is our unique multi-bay strategy. This has worked quite well for us. As noted in the video, our multi-bay strategy allows us to do much more with our water holdings, with each bay taking advantage of each attribute it has and allowing our teams to specialise. And in addition, the multi-bay provides graphic diversification, which is key for managing bio risks. Next slide. The stock profile has improved towards larger sizes with the COVID slowdown. This has allowed us to really take advantage of this. Summer and autumn conditions in all our bays resulted in significant improvement in stock profile. Our oysters, plates and standards. Immature stock on hand has increased significantly. Further improvement in that stock is expected also in Q4. Average price per oyster expected to improve as a result of improving sales mix. Angel currently has 22 million healthy graded oysters, as mentioned earlier, across all our farms, and Haslam is a warehouse facility back in use now with the extra biomass. Next slide. Actions taken to offset impacts of COVID. Angels are focusing on positioning Angel for the long term. We are a primary producer, and our focus has always been long term, and we're in the right place to do that. The slowdown in sales due to restaurants around the world. April-May sales averaged 50% pre-COVID-19 forecasts, with domestic sales in retail channels being a bigger hit. Silver lining in the sales slowdown has been the opportunity to further improve our stock profile, which can be hard if you're ramping up sales. Implemented decisive actions to offset the adverse impact by slowing cash burn, and we think all actions have been taken properly for the long-term view for Angel. Positive signs. The sales recovery experienced in late May, early June, as restrictions are easing, have really been positive. And next slide. COVID-19 driving sales growth in the retail market. This has been another good opportunity. slow down the restaurant sales has fast-tracked Angel's strategy to build its retail sales program. We see significant opportunity to further increase that penetration with retailers. At the moment, currently, less than 20% of major retail stores sell oysters. This was the same case for salmon many years ago, but since increased the to approximately 70%, driven by changes in consumer behaviour, retailers improving their seafood offering. And Angel, in early stages of premium branding exercise that'll capitalise on this demand for organic and sustainably sourced clean oysters, is another big opportunity for us to capture. Next slide. The exports represent a long-term opportunity for us, and this is obviously a no-brainer. Asia represents a large opportunity given strong demand for clean and healthy oysters and furthermore seafood. Peak global demand during Northern Hemisphere summer coincides with peak conditions, and Australian oysters present significant opportunities. Northern Hemisphere oysters are out of season at the same time as our oysters are in season. We're well positioned to grow the exports with improved stock profile, larger size to meet preference for Asians loving everything big. Next slide. Outlook for Angel. We are very, very well in a good position, we feel, as demand recovers. We'll continue our domestic sales into retail channels, including large retailers. Significant opportunity to expand this channel, we see. Progressive easing of restrictions to combat COVID-19, reopening of restaurants expected to continue increasing demand. Focus on further improving the stock profile with larger oyster size while restaurant demand is subdued, positioning Angel for strong growth once consumer demand returns to normal levels. An export sales program recommenced in May, demand expecting to pick up in coming months with Northern Hemisphere oysters starting to run out of season. And finally, increasing global consumer trend towards healthy, clean and safe food choices, and Angel's competitive advantage, the only organic and sustainable certified growers in the world, gives Angel the opportunity to capture a high premium on demand. That's it for my presentation. Thank you all for listening in. We'll now pass back to Eric for Q&A and fire any questions you have at us. I'm happy to hear.
Thanks, Zach. So just a reminder for all of those that have dialed in to either use the Q&A function to log a question, or to email Ron, ron.bachelor, BECHLER, @marketi.com.au. So Zach, while we just, we've got our first question come through from Anthony Wilson asking, who is your biggest competitor?
Biggest competitors are probably agents. They buy and sell for many small growers. So there's a numerous of agents out there at the moment that are doing this, and this is where we've been taking advantage of the consolidation to increase our continuity of supply into the market and brand our own oyster and as Angel.
And just an extension of that question is, and what's Angel's market share?
Sorry?
What is Angel's market share?
We represent around 20% at the moment.
Great. We've got a question from Mark Topi asking how the progress of the brand building for your oysters from Coffin Bay is going, and what the opportunity for the branding going forward is.
Yep, good question. I think our main focus during COVID has been building the extra biomass that we've held back from reduced sales. The marketing is not and strategy is a very it's not an easy easy route to take, because there's a lot of steps involved in getting the marketing pushed through. But we are working very closely on it, and we're hopeful we'll be having some representation in the market in the next coming 2 months.
Thanks, Zach. An extension of that question was there any disruption in the with wholesalers during the COVID-19 period? And do you see any issues there as things get back on track in retail and the restaurant space?
I don't think there was. I think the wholesalers were obviously just focused on retail sector as well. Restaurants and everything being closed, it was hard for them to, they weren't doing any sales in there. I think a lot of them, our wholesalers have held pretty steady and probably enjoyed a bit of a break, to be honest. But our focus is to really ramp up a bit more wholesale and increase our significant market share in that we're going to.
Thanks, Zach. Just a question from me. I'll just give it a moment to see if there's any further questions that come through. Is obviously you've built up a large position in South Australia. How much bigger can you get in South Australia? And then perhaps beyond South Australia, what are some other longer term growth opportunities?
Yeah, there's a lot more opportunity in South Australia, even within some of our own assets we're already holding. We're only a third of developed in Haslam for a warehouse. We've got very productive water in other bays that we can leverage from. And as more opportunities come available, and if there is any sale out of this last COVID economic hit, we want to be probably looking to take advantage of those things. But to be honest, we've been in survival mode the last few months, and we're just been head down, bum up, and not being too clever at the moment.
Okay, thanks, Zach. It looks like that's it for the question. So appreciate you making the time. And I might ask Simba now to stop sharing his screen, and I'll hand back to Ron. Thanks, Zach.
Thanks, everyone.
Thanks, Zach, and thanks, Eric. Actually, we're going to do a bit of a relay race at the moment, because I'm going to pass the baton right back to you, Eric, to introduce our next speaker, which is Chris Massas, the CEO of Advent Health. So I'll just, while you're doing the introduction, Chris, I'll share this with you so you can share your screen. Thanks, Zach, and thanks, Simba.
Thanks, guys.
All right. Yes. So thanks, Ron. Again, as Ron said, we've got Advent Health presenting now. A unique opportunity here, and I think it would be the first unlisted company we've had it present at Market Eye's virtual conference series. So yeah, I might hand over to Chris now to talk through Advent Health and what they're doing, and perhaps even talk up to the coming IPO as well. So over to you, Chris.
Yeah, great. Thanks, Eric. I'll let you load up the slides and navigate through, if that's okay. Before you, or as you're doing that, I'd just like to an acknowledgement of country. I pay my respects to the traditional owners across the country where we're meeting, and pay my respects to elders past, present, and emerging. Yes, we're a healthcare business, and certainly the healthcare consumer is changing the landscape of the way a healthcare business will be designed. And the presentation I'll go through today is basically the way we've gone about forming Advent Healthcare, and the key ingredients to make a future healthcare business viable in the current landscape. So Eric, are you loading up the preso?
I am. Let me just share my screen.
Great. Okay, so just on slide 2, thanks, Eric. So Advent Health, so what are we? We're Australia's largest leading multidisciplinary allied health group. And that's the visual you have on the screen is what we're taking to market in a couple of weeks. Our founding group is comprised of 12 vendors, but as you can see, we have 59 locations across the country with over 300 clinicians in our network. Obviously, we're Eastern Seaboard dominant, but certainly we have a footprint in South Australia and Western Australia. And that's important because I'll talk a little bit, the reason why a little bit later. In the blue box there, you see the Advent Health specialties, and those that aren't exposed in the health sector sometimes don't realise what allied health is. And basically, if you think of medicine, nursing and pharmacy, everything else is usually considered allied health. So quite often we associate physiotherapy, chiropractic, psychology, osteopathy, exercise physiology, all those modalities and more in that blue box. But it's important to note that Advent is a group of groups. And this was designed by no accident. It's really a fundamental principle in the structure of the organisation. In a previous role, around 5 years ago, I commissioned some research on what the healthcare practice of the future should look like in 2025. So it was a 10-year futuristic piece. And many of the elements that came out of that research are based in the Advent model. And a few of those I'll go through quickly. Firstly, being clinically led. It's really important in healthcare that clinicians are engaged, have skin in the game, and actually are part of the running of the organisation. Certainly a consumer focus, and we're seeing over the last 5 to 10 years, the flipping of the way healthcare is provided. It's very consumer led, whereas back in the day, you would have gone to a clinician or a doctor and they would tell you what to do and how to look after your healthcare. Healthcare now is quite different, where the consumer all have unique needs. They're quite educated with arguably Dr. Google, and it's almost a co-design of a healthcare plan to get better. And that's a key difference in the Advent model. Being tech enabled, so having IT and data and infrastructure will be critical. An avoidance of what we call sole clinicians or sole practices. You certainly need some size, scale, and footprint with the funders, such as Medicare and private private health insurers. But the big one for us has been the development of a multidisciplinary service offering. And I touched on those modalities in that blue box earlier. When you look at the burden of disease in our society with cancers and heart disease, musculoskeletal issues such as back pain, arthritis, all those are treated with therapies and advisory pieces. But I think the big one, and we're going to see this over the next decade, particularly coming out of COVID-19, isolation, economic uncertainty, is the mental health burden. And so for us, Advent Health not only has all the physical therapies, but we also have a strong mental health offering. So we feel it's a very strong holistic health offering in primary care in the community. And I think that would be critical for success. Next slides, please, Eric. Now we have a very strong diversified practice portfolio. As you can see, each state has a variety of offerings. What I want to bring your attention to briefly is where in healthcare, it's actually essential, and we recognize that local brands are very important in local communities. Healthcare is not a commodity, so we have designed it in a way that we're not being a head office dictating how to brand, how to color, how to what items to use from a branding point of view. We're keeping all our existing brands and existing businesses because these are very high performing organizations in their own right who have local partnerships, local connectivity to their community, and local patient base. So for us, we feel not only is it important that they're part of the group and the network, that their local branding and marketing that they've developed over their successful years will be maintained, and that's critical in growing the businesses. In terms of the highlights of our portfolio as a whole, again, it shows the diverse nature of this founding group that we're taking to the market. One of our vendors, and you'll notice in the top left, Ardius is the single largest allied health provider to primary health networks in Australia. And what that means, again, for those that aren't involved in the sector, PHNs or primary health networks are the gateway to federal government funding. And so they're commissioners of health services. So RDS is one of our strong mental health businesses, and they're out of the 7 primary health networks in Queensland, they've got contracts with 5 of them. There are 31 primary health networks across the country. So again, for us, it gives us the ability to then go and tender and pitch for work across the country with these primary health networks. One Point Health, which is a strong New South Wales business, is one of our largest clinics in Australia for multidisciplinary allied health services. This is what we term as your big box health service, with 23 rooms, a dedicated gym space, a retail component because of their orthotics requirements, being a podiatry-led business. But certainly the number of services offered in that space is significant. We also have the largest Queensland and New South groups by pure number of locations. And we're very conscious that although we do have a metro footprint, we also have some regional businesses, and the demand in healthcare and in regional Australia is critical, to the point where the demand outweighs the supply. So we have some innovations on how to service that. And the other, I guess, identifying feature, we have a number of businesses that really specialise in certain services. And we give an example of women's health, and we have a business in Victoria called Fitwise. Prenatal and postnatal care for women is critical, and quite often the allied health services associated with that, whether it be mental health support, Pilates, exercise, physiotherapy, rehab, prenatal and postnatal is critical. And again, we have a number of offerings in that space. Next slide, please, Eric. In terms of the value add that Advent Health provides as a business, there are a number of challenges in the sector for small practices and groups, and a lot of them are listed on the left-hand side there. Probably the big one is a lot of the business owners in this space quite often lack the ability to get financial capital, the strategic human capital required to scale up, and really expertise in running a practice. And for us, we have a strong centralized support, including benchmarking, coaching. We have financial backing and the ability to cross-promote and provide new services. The other challenge in the allied health space is clinician retention and education. And again, our desire is to build centralized programs to really upskill staff, increase the range of services offered, but also career opportunities, because quite often clinicians 2 or 3 or 5 years in hit a glass ceiling and they feel they're not challenged in their profession. So for us, it's around providing the opportunity for diversity, not only in the way they deliver their services, but maybe cross-promoting and cross-skilling in areas of business and strategy. Patient retention is critical in any business, client retention. But again, what we want to offer is a diversity of service offering, really target marketing to improve patient retention. And this where things like big data, tech, and all the back-end systems required around practice management need to be centralized, efficient, and really leveraged to ensure that we are putting our arms around our clients. At the moment, we have around 500,000 patients coming through the Advent Health doors, and we think we can double that in 2 or 3 years by simply using the big data that is available and web-based practice management software. Next slide, please, Eric. We've been on this journey for 2 years, and it's been quite a targeted approach to identify quality vendors. We've said no to more vendors than we've said yes, and that's been deliberate because we felt with the right ingredients and to be a successful future healthcare businesses, certain elements needed to be met. I'll just go through a couple of those. They're all listed on this slide here, but again, as I said earlier, we are a group of groups, so no single operators requiring some scale. Some of these businesses are already on a corporatized roadmap. So actually corporatizing further is not a stretch for them. We're not up against resistance. We have vendor alignment, we have cultural alignment. So finding further synergies and actually growing the businesses are aligned with all of us. Primary locations for growth. As I said, we have great metro presence with the ability to grow there, but certainly a regional footprint is required. And I think having trust in regional communities is critical to allow for growth. As some of these businesses are already on that corporate journey, the ability to drive efficiencies and really targeting back-end synergies, if you like, to increase profitability is part of the cultural DNA of the organisation. We've acquired market leaders who either have an excellent reputation, are clinically led and evidence-based, or they have a real specialist offering that, again, we can have as a complete Advent Health offering in the community, going from that multidisciplinary approach around mental health, physical health, prevention and wellness. And obviously a critical approach to having some sort of turnover. So we've had a minimum benchmark of a revenue of $1 million plus and growing. And we've got financials for the last 2 or 3 years and pro forma financials over the last 2 or 3 years. The next slide, please, Eric. The vendor selection and the incentivization of our vendors is also critical, and part of the design of our organisation is to give the vendors 30% payment in Advent Health shares. So again, that's giving them skin in the game. It's giving them alignment to the organisation. Many of our vendors are mid-career, so it's certainly not an exit for them. They've reached a point in their business where they can't grow anymore without the support of a support office like Advent. So for us, I think it's a match made to actually grow together. Some of our vendors have property arrangements where they are the landlord, so we're giving them long-term property lease arrangements. We have vendor service agreements, which are a minimum of 3 years, where they are either salaried or have a percentage of the revenue derived. And actually dovetailing into that is having their shares in escrow for a voluntary escrow for 2 years. And we deliberately made them 2 different time horizons to ensure that they don't, for example, exit with their shares and then exit as a vendor service arrangement. So again, it's been designed quite cleverly, but also giving the incentivization and increasing profits for the vendors as well. And we also have earnouts and clawbacks as required. Next slide, please, Eric. Just the market itself, on the left-hand side, some key stats around the allied health industry. People don't realise that it's nearly an $11 billion industry, and obviously Kelly Partners indicated that the advisory game is $11 billion. Allied health is in a similar ballpark. But in terms of growth, just at an annual growth, it's over 3%. Now, our vendors collectively have been growing at 7 or 8% over the last 2 years. And so that's, for us, they're well-performing businesses, and we think we can grow that even further. Firstly, organically, with rolling out new greenfield sites or introducing additional services to our practices, but also the cross-referral ability as a multidisciplinary offering. And then the vertical integration piece, for example, in podiatry, operating an orthotics laboratory. And then the network expansion. We certainly have, allied health is a sector that is very connected. And so as word gets out, we have many people knocking on our doors and asking if we're open to acquisitions. And certainly we will, in the first 6 to 12 months, we have a pipeline of strategic acquisitions that can really plug and play quickly into the culture, the DNA, and I guess the spirit of the way Advent Health wants to run our organisation. Next slide, please, Eric. I'll just run through a quick patient story, and a lot of us washed up sports people can probably relate to this patient. John, he was an avid footballer and golfer, and this is from one of our vendors. And we've changed the names for privacy, but he suffered from constant back pain, so probably my vintage. On the recommendation of a work colleague, saw a physio, saw a chiropractor for a series of treatments, but really his condition didn't improve. And as a result, he reduced his exercise, put on some weight, really negatively impacted his mood, and his mental health suffered. He presented at one of our vendors, and his initial appointment had nothing to do with therapy. It was all around a detailed diagnostic and an assessment, an independent one, to really determine the appropriate treatment plan. It's really important to get a holistic approach from a different set of clinicians to take some detailed history. And what was found, because he had a complex set of problems, the underlying cause of his issue was actually a foot problem. So it was a podiatry issue which exacerbated his weight gain because of the exercises he was previously prescribed. So from our point of view, that multidisciplinary approach, you were able to give him 6 months of treatment, not only from the podiatrist for the foot issue, the physiotherapist from a rehab point of view, the exercise physiologist to do his exercises, the dietitian to actually get his diet and weight down, and then to get pain-free, and was able to return to football and golf and without mobility limitations. So it's a typical case of how someone presents in a complex environment. We don't want to commoditize healthcare. Everyone is unique and different. And it goes back to the consumer leading the healthcare they want. He wanted to get back to football and golf, and we designed a program and a service around that with those aims in mind. Next slide, please, Eric. Look, I'm just conscious of time, so just quickly, our offer is open currently, so we are doing roadshows, and we close in 2 weeks, and we will commence trading on the 16th of July, and our ASX ticker there is on the screen. Just some high-level metrics. Our EBITDA to enterprise value is at 5.8 times, and NPAT to market cap is 11.4 times, which are very competitive. We've done some benchmarking against Healthier, which is probably the closest competitor per se in a listed environment, albeit they have only 2 modalities, podiatry and physiotherapy, and we're certainly the multidisciplinary offering with mental health and other modalities. And again, just the final pitch there, we have market leading practices, vendors really aligned with our strategic vision and our culture. Health at the moment is just exploding healthcare. So we're in a growth market. We have a pipeline for expansion and growth, the back-end systems and support, and certainly from a listing point of view, we are competitively priced for investors. I think the next slide is the last one there. Yeah, so I'll leave it there, Eric, and happy to take any questions or comments from the audience.
Hey, thank you very much, Chris. Ron, if you're there, I'm just sharing the screen, so I'm not seeing the Q&A function. So if, actually, I've just pulled it up now. So if you just bear with me. So yeah, just a reminder to everyone, if there's any questions, please use the chat function, or alternatively, you can email ronn.bachelor, BECHLER @marketeye.com.au for any questions. Chris, while we wait for any questions to come through, I might start with one. Obviously, most industries, or many, have been impacted by COVID-19. In terms of the businesses that Advent will be acquiring, how have they performed over the last 2 months, and perhaps maybe more relevant over the last couple of weeks and the trends that you're seeing there?
Yeah, look, thank you for the question. Very early in the pandemic announcement, the Minister for Health announced that allied health was an essential service. So that really helped. 59 clinics actually didn't close. There was a downturn in foot traffic, but many of our vendors were quick to respond and were quite robust and resilient through the last 12 weeks. Our lowest point when the CFO and I sat down with the vendors on a daily basis, our lowest point was probably mid-April, where we were down 20%. I think that's mainly 2 or 3 of the vendors. The majority of our vendors were very strong, given their size, the ability to look at their expenses, to dial up and dial down where needed, negotiate with landlords and with other suppliers. So their margins actually maintained quite quickly. I think where we saw an impact mainly was those that had specialist services around Pilates, around and gym areas, and also because of the closure of elective surgeries, we had some vendors who aligned with community rehab weren't able to do that. But we're pleased to report that we're back to pre-COVID levels, to the point where some of our vendors are having the best weeks of the year. So it's really a good indicator of the resilience of this model. When you have quality vendors, the ability to adjust quickly, and the support of a central office, given the announcements from the government around funding for telehealth, funding for mental health. I think what we saw was a little dip, but certainly a real rapid increase and back to normality, probably more so than other sectors.
Thanks, Chris. Just a reminder again to all those online to use the chat function. Another question here is, how do you specifically plan to drive efficiencies through your acquisitions? We've seen, I know you don't like the term any roll-ups, but how do you, how does Advent plan on driving those efficiencies?
Yeah, we roll-ups. I don't think this is a typical roll-up though. As I said, some of the features of our vendor selection are semi-corporatized, so they are actually on a journey. We've had a really long run up to this over 18 months, and for us, we've done a lot of work around the ability to integrate, not only from a systems point of view, financial point of view, but then looking at the data. So for us, we know what practice management software all our vendors are running, and we've actually agreed on a common platform going forward prior to acquisition, for example. Certainly procurement is another area where we have vendors procuring in different ways. So certainly that's one area. Centralizing HR and payroll, again, another, probably not an expertise done at a vendor level, but something that we can do at central support office. We've got a team that our CFO, Rob Andrew Arthur, is out of Solomon Lewis Private Companies and has done a lot of integration work, a lot of tech work, a lot of transition work. Similarly, our Chief Performance Officer is out of Siemens in an M&A environment. So we have skills internally that have got a background in looking at businesses in terms of mergers and acquisitions, looking at where we can add value from a central office point of view, but also leaving our clinicians to do what they do best, and that's treat their patients, get people better, get people through their doors, and the community partnerships. So we think we can add a significant amount of value from a support point of view, given the group of groups that we're inquiring.
Thanks, Chris. Another question's come through just around the cap structure. So what is the current ownership structure, and what will the level of post-listing holdings, what level of the post-listing holdings will be escrowed?
Yeah, sure. So on average, it's 30% shares held by the vendors in the organisation. So the total listing will be, sorry, 27.2%. So I think what we don't own the businesses currently. We'll all have sale and purchase agreements, and once the raise is done, we've got also some bank debt available to match that to finalise the acquisitions. So at post that, they have 2 years escrow on their shares, so they'll have just under 30% of the organisation.
Okay, thanks, Chris. That looks like the last Q&A, so I'll hand over to Ron.
Thanks, Eric. And thank you everybody for joining us for this morning session. Chris for presenting on Advent Health. We look forward to seeing you hopefully all for the afternoon session that commences at 2 o'clock. We've got ProPack, AU Make International and Murray Cod Australia. Look forward to seeing you then. In the meantime, have a good lunch everybody, and have a good day. Thank you very much. Goodbye.